Welcome, everyone. I'm Monique Botkin, Associate General Counsel at the Investment Advisor Association. This is an IAA member call to discuss the SEC's new equity market structure proposals and broker-dealer best execution proposal and their potential impact on investment advisors. As you know, the SEC proposed 4 separate rulemakings under the Exchange Act in December, and comments on these proposals are due by March 31st. We want to emphasize that there is no separate proposal to amend the Advisors Act, but the rules will impact the way advisors trade for their clients. We're fortunate to have Ignacio Sandoval, a partner at Morgan Lewis Bockius, join us today to discuss the proposals and also highlight how they may impact advisors and their clients. Ignacio advises broker-dealers and other securities intermediaries on compliance with the federal securities laws and SRO rules. And prior to joining Morgan Lewis, he was a special counsel in the Office of Chief Counsel in the SEC's Division of Trading and Markets. We'd like to remind you to please keep your lines on mute. If you have questions, you can send them in the chat, and we will either try to address them today or we'll get back to you after the program. And this call will be recorded for members, so you can feel free to share. We'll provide the link on our website in the webinar page. So Ignacio, thank you so much for being here today. I know there's a lot to cover, so I'll turn it over to you.
Thanks, Monique, and thank you for having me. And so there is a lot to cover. There were over, I think, 1,600 pages to read. I did read them over the holiday break and reread them. So lots of a dense technical material to get through. So, I try to keep it at a high level. Some stuff I think merit, or some of the materials I think does merit more of a deeper dive, some less so. But I think for some of the membership, I think the interest or the impact may vary or be more important depending on sort of the trading strategies or the business lines. But, I think we can jump in. As Monique mentioned, 4 rule sets or proposals. 2 were amendments and 2 were new rules. So Rule 605 amendments, order execution disclosures, that's an existing rule. All it does is sort of enhance existing obligations, but it's going to be impactful, as we'll discuss, because it just creates additional data that's going to be out floating around that can be used for analyzing trade quality and execution quality, not just for broker dealers, but for pretty much other market participants. Amendments to Reg NMS, probably the big things here are sort of tick size, right? We're moving towards sub-penny quoting. Trading at sub-penny has been happening for a while, but now we're actually going to have sub-penny quoting at above $1. And sort of the change to the access fees, that's going to be a little bit impactful, especially when we get to the order competition rule and sort of how that's going to impact payment for order flow. That's important. I think a year or 2 ago, we heard Chair Gensler sort of making rumblings about banning payment for order flow. That didn't happen. That didn't happen in this proposal. I think it would have been devastating for the brokerage industry. But I think some features of this proposal may end up hampering or at least potentially causing a chilling effect on payments or receipts. So we'll get there and sort of share my thoughts on how that could impact that. Probably one of the biggest or the most impactful proposal to come out of this is the order competition rule. However you view this rule, it's going to effectively require that retail order flow, instead of going to the wholesalers, which I think inside the commission has become a 4-letter word in some respects. It's going to require that retail order flow be exposed to these retail auctions. So the rule is designed presumptively to sort of improve competition. The cynic in me and perhaps others kind of view this rule as, or this proposed rule really as a lifeline to the exchanges. And so we'll sort of talk about the structure of this rule and how it's going to play out, and sort of as a practical matter, who actually can develop these auction systems that are supposed to be used. And finally, we'll talk about regulation or proposed regulation best execution. In some circles, it is just really a rehash and an SEC implementation of existing SRO rule requirements. And in many respects, that's true. But in others, It's not. There are significant additional requirements that broker dealers would have to comply with, and additional obligations and additional reporting requirements that may impact how advisors and other money managers sort of review and consider their obligations. And finally, although most of these rules really impact broker dealers, there are going to be potential impacts to money managers and advisors. So, I'll quickly highlight some of those towards the end of the presentation. And with that, we can start. Start with Rule 605. So the current rule, Rule 605 in Rec NMS.
Ignacio,
Yes.
all right. Did you want to advance the slide?
Yeah, I think we in 605.
Oh, okay. I must not be looking at the right screen.
No, it's not updating.
The slides have not been updated.
They have or they haven't?
Have not.
It should be the current Rule 605.
It's still your title page.
Oh. Is that
There we
better?
go. Yep.
All right, we'll do it this way.
Thank you.
It's probably easier. So current, sorry, this was the agenda. That's what I was sort of going over. Not sure why the slide presentation wasn't working. Sorry about that. So we'll jump down to current Rule 605. So current Rule 605, current iteration of this rule just requires public disclosure of execution quality and order routing practices. So what this rule requires is that market centers make available on a monthly basis sort of standardized information about execution quality for covered orders. So obviously, I underline these terms because these are sort of significant defined terms for NMS stock, right, that they receive for execution. So NMS stock pretty much means, listed securities and securities that are subject to last sale reporting. So what the market centers must provide are measures about execution quality, spread, price improvement, number of shares executed, speed of execution, right? So it sort of measures you would want to know about a market center when you're, deciding whether you want an order to be routed there for execution, right? What's the quality of the execution? How quick is my fill going to be? Is my price going to improve when I send it there, right? These are different than the Rule 606 reports that you might see, right? That's usually a PDF that you might see with sort of different metrics about order routing destinations and payment for order flow. If you look at the Rule 605 reports, it's usually a zip file with a bunch of data, right? And usually that data is going to be fed into some sort of black box and it's going to be analyzed. So not really user friendly. It's usually a machine readable data. So under Rule 605, currently, right, a market center is an exchange, an OTC market maker, an ATS, an exchange market maker, and FINRA, right, a National Securities Association. And a covered order, very, very specific definition, right? Market order or limit order, usually received by a market center during regular trading hours, usually going to be the MBBO. So again, you have to make these reports available. If you just Google a Rule 605 report, you'll get hits for a bunch of the different OTC market makers and trading centers. These are available. They might have them on their own websites. Sometimes they'll use a third party to disseminate them. So what's the rule going to do? What's the SEC sort of changing here, right? Well, they're expanding the types of entities that need to sort of provide these reports, right? And so the biggest one here is that they're going to loop in a bunch of larger broker dealers, right? So under the current definition of a market center, right, the only broker dealers that have to report are exchange market makers and OTC market makers, and some of those ATSs, right? Or ATSs rather, right? Because ATSs are all registered as broker dealers. Now, right, captured within scope are going to be those broker dealers that introduce or carry 100,000 or more customer accounts, right? So that's going to capture your vast majority of clearing brokers. But, also a handful of introducing brokers that sort of introduce to some of the bigger carrying firms, right? So it's going to capture both of them, right? Not just the introducing firms, rather not just the carrying firms that are carrying the positions, but also those big introducing firms that are introducing to the bigger carrying firms, right? According to the SEC's sort of statistics, I mean, they're looking at about less than 100 of these firms that fall within this category, but still, that's a pretty big number of additional firms that are going to have to be providing these reports, right? So this is in addition to whatever reports that these BDs are going to have to provide, right? So let's say you have a broker dealer that's a wholesaler, right? Because it's an OTC market maker. So it's going to have to provide a report for those activities, right? So if it's internalizing order flow as a market maker, it's going to have to provide a report for those activities, and then separately provide a report for its activities with respect to these accounts that it's introducing, right? So one broker dealer might have an obligation to provide multiple reports. Same thing with the qualified auction mechanism, right? So if an exchange or a BD is running one of these qualified auction mechanisms that we'll talk about in a few slides, they're going to have to provide a report for each one of these separate business lines. And then single dealer platforms. What these are those what the SEC is talking about here is those wholesaler mechanisms where they internalize the order flow. So but in describing these platforms, what the SEC was talking about is wholesalers, right? The big wholesalers that internalize flow, they're typically going to come within the meaning of an OTC market maker, right? So they may have OTC market making sort of responsibilities. They'll have to sort of provide a 605 report for those activities. Separately, they didn't have to sort of provide reports about their internalization activities, right? When they internalize order flow, when that stuff was routed to them from the retail shops, now they'll have to separately provide 605 reports for that internalization activity. And I think what the SEC was trying to get at, and sort of the rationale for this, is that, hey, there was so much order flow that a lot of these wholesalers were internalizing. We just didn't have, there just wasn't any meaningful statistics about execution quality, right, or price improvement, or what the fill rates were, right? So that's why they're trying to force these reports out. So pretty big expansion. Lots of more data that's going to be available now. So not only are they expanding the types of entities that have to provide these reports and this data, they're also sort of expanding the types of orders now that are going to be subject to these types of reports, right? So orders that are submitted before and after closing, stop orders as long as they're executable at some point, and certain types of non-exempt short sale orders. In addition to that, they're sort of changing the category of order sizes, so that now they're going to be capturing smaller order sizes. I think that's a recognition that, at least in the current sort of state of affairs, round lots are, you have to sort of account for round lots being much smaller in size than just 100 shares, right? You're getting share trading in much smaller increments. Oh, sorry about that. In much smaller increments, and also you have to characterize round lots in different ways, right? Given that some share prices are incredibly high, and you have a lot more retail flow now that's consisting of like fractional shares, or depending on the type of institutional investors, really large order types, right? Depending on the institution, right? That wasn't previously captured in these reports. What the SEC is now saying, hey, we want to capture that data and make sure we're pushing it out. That way the market at least has this information to sort of consider, right? In addition, they're just capturing a bunch of different order types that maybe weren't around when 605 was initially sort of adopted. And sort of the last thing, and maybe much more consequential to sort of maybe money managers, is sort of these monthly reports now, right? So under Rule 606, right, you had these sort of human readable, usable PDF monthly reports. Now with the SEC saying, hey, effectively, market centers that produce 605 data, you got to produce these monthly reports in a usable format for the traditional sort of investor that can use them in a practical sort of way. So instead of a machine readable format that you have to download, put into a black box and analyze, you also have to effectively produce a PDF type document that the average person can use. Right, so I expected that the 605 reports that are going to be produced, if this is adopted, are going to look very much like the 606 reports that some of you may have seen or come across. So those are the 605 amendments. From my perspective, the big takeaway from this is that this is just going to produce a lot more data. And when we get down to the best execution rule, all this data is just going to be part of the data set that broker-dealers are going to have to use when sort of judging and evaluating and analyzing sort of their best execution decisions and destinations, right? So not that money managers or advisors are going to be subject to this SEC best execution rule, but it's going to be presumably part of the mix of information that money managers may have to consider when considering either broker-dealers or the destinations that broker-dealers choose when routing their orders, especially now that introducing firms and clearing firms may have to start sort of providing these reports and making them publicly available. So jumping next to the next proposal, really the changes to tick size, access fees, and transparency. So on tick size, this is just the amendment to Rule 612. So right now, what the current requirement is for NMS stocks, right, on quotations, if they're priced at or greater than $1 per share, the minimum pricing increments a penny. And for quotations at NMS stock priced at less than $1 per share, right, it's at a sub penny, right? So this is for quotation, not for trading. For trading, historically, you've been able to sort of trade at sub penny increments. You just can't quote. So the proposal now is that you're going to have variable minimum pricing increments for quotations and orders, and IOIs and an NMS stock, right? So if it's at $1, there's going to be this new time-weighted average quoted spread measure or mechanism, right, by which you would you use this calculation based on a sort of month-long evaluation period. It's highly technical. It's a month-long evaluation period where you would sort of weigh the average quote, and depending on what those spreads look like, you would have a varying sort of pricing increment for that particular security. It's probably easier to sort of visualize it, right? So if this, and this is probably the best visualization I think that there's out there, right? It gives you a bit, it lets you know what sort of the pricing increment, what the sub penny pricing increment can be based on sort of what the spread was for that particular security during the evaluation period, right? So, won't go into too much detail here, but it's giving you sort of a period by which to evaluate a particular security, and then based on that evaluation, it lets you know what the pricing mechanism, or rather what the pricing increment should be. Obviously, the issue here is that it's going to require a significant technology build, right? And sort of some of the unanswered questions here is, where's this trade flow coming from, right? Is it going to be coming from the exchanges or the BDs, and how's this technology build really going to come to fruition if this gets adopted? Some question as to sort of what impact this is going to have to pricing stability. I'm not sure. I didn't read the economic analysis well enough to see how they considered this. But this is this proposal. I'm not sure folks really I haven't seen a lot of noise on this one in terms of objections to it. But I think it's partly because I don't know that folks have really considered what sort of real impact this is going to have to pricing stability. But I'm still sort of exploring the comments on this, mostly because as I reread these proposals, I get different insights from reading the different proposals I get epiphanies from reading one proposal that I get from another. So on this one, haven't seen a lot of noise on this one yet, but we may get more insights as the comment letters come. And then finally, access fees, Rule 6110. So this imposes a limit on the fees that can be charged to access protected quotes on the exchange. So the current requirement is for NMS stocks priced at $1 or more. A trading center can impose a fee at above 0.003 cents per share. And if it's less than $1, it can't exceed 0.3% of the quoted price per share. The proposals should reduce that. So if it's priced at $1 or more, it can't be, the access fee cap would be 0.005 cents per share. They have a minimum price increment of 0.001, and then the access fee cap would be 0.001 cents per share if there's a minimum price increment of greater than 0.001 cents. And if it's less than $1, it would be capped at 0.05% of the quotation price. So this is significant because when we get down to the order competition rule, we'll see that the rebates that an auction center can pay out is going to be limited to this cap, right? And I think the other thing that's significant about the reduction of these caps is that what an exchange effectively pays in rebates or what they reduce in fees with respect to sort of attracting liquidity oftentimes is directly correlated sort of to the access fees they can charge, right? So the reduction in fees that an exchange can charge, right, has that direct correlation to payment for order flow. So as I mentioned a little bit earlier, Chair Gensler initially wanted to, or was toying with the idea of eliminating payment for order flow. He didn't do that, but there's a bunch of mechanisms in these proposals, right, that effectively serve to get to that aim without doing so directly, right? Reducing the access fees, right? So suddenly there's less money by which to pay rebates or to reduce fees. So this is just an example where the different mechanisms of these rules are going to serve to sort of reduce the revenue sources that I think in many respects brokerages have come to rely on in order to not charge commissions, at least in the retail space. And here's sort of another big one here. Part of the proposals in Rule 612 is that all exchange fees and rebates are going to have to be determinable at the time of an execution. So currently, if you're going to get a rebate, that didn't have to be determined before you sent the execution, right? Most of the rebates were going to be calculated at the end of the month, right? You'd get a rebate at the end of the month based on your order flow to the exchange or the trading minute. Now, that has to be calculated beforehand. So why is that important, right? The reason that's important is when we get to the best execution rule, right? Under the best execution rule, if a broker-dealer is getting payment for order flow, it's going to be considered a conflicted transaction. If a transaction's conflicted, a broker-dealer has to go through more hoops before they decide whether they're going to route an order to a destination that pays payment for order flow, right? Now that they know what the amount of the rebate's going to be, that adds to the calculus as to whether they're going to be able to route to that particular destination. So that's why I think this requirement is significant, because it sort of adds an extra layer to this potential chilling effect in the decision as to whether you want to receive payment for order flow or not, right? Because if you do, then you got to question whether you're suddenly running afoul of your BAS execution obligations. Then finally, probably not as significant, well, still significant, but probably not as high profile. This concept of transparency of better priced order. In 2020, the commission adopted the market data infrastructure rules. What it's really doing is it's accelerating the definition of round lot and odd lot information definitions. And what this is really supposed to do is increase transparency around these types of orders and the information around these orders. So as part of these proposals, they're going to accelerate the adoption of these rules. So that's, this is really part of that package of rules that the commission adopted. So, probably not as impactful to money managers. Perhaps, the DIC price and the price and improvement mechanisms tangentially, but, not as directly as perhaps the data that's going to be available under the 605 monthly reports that'll be available. Perhaps more significant now, not to the meat of the substance, is really the order competition, right? This rule really has the potential to sort of restructure the U.S. equity markets. And this is probably the most significant of the rule packages that the SEC has proposed. It's funny, this earlier in the fall, I went to an equity market structure conference, and even then, it was in the fall, folks were still skeptical that the SEC was going to adopt this rule. So I think a lot of folks were still surprised that Chair Gensler actually went through with it, just because folks really didn't think that this was actually gonna that this rule would or this mechanism could actually work, right? So what is it? Proposed Rule 615. Right, so what it would do is it would prohibit a restricted competition center, and we'll get to what that means in a second, from internally executing a segmented order. So a segmented order is just a defined term for effectively a retail order for NMS stock until after a broker dealer. So when you think broker dealer, think wholesaler, right? Because that's effectively what Gensler's going after. Until the broker dealer has exposed such an order to competition at a specified limit price. So just think a price that the broker dealer has inputted in a qualified auction that is operated by an open competition trading center, right? So you have the qualified auction component, and then you have an open competition trading center, right? So the qualified auction has to be run by something called an open competition trading center, right? So once you have this segmented order, right, the retail order, if it's not executed in the qualified auction, the restricted trading competition center, right, think the wholesaler, right, if it's not executed at the qualified auction, the wholesaler, as soon as possible, after it's not executed there, can execute it internally at a price that's equal or more favorable for the segmented order than the specified limit price in the qualified auction. So for this, I didn't include it in the deck, but just because I didn't think there was an example, but then I ended up finding it. I figured I'd provide the description that the SEC provided, and even there, the description is a little sort of it's not clear, and I think it raises more questions than it actually answers, right? So the way that the SEC sort of described this working is you have a situation, right, where you assume that a broker dealer routes a customer's assume a retail broker dealer routes a customer's order, a retail customer's order to a wholesaler, right? Right. So typically, under sort of current market conditions today, right, the wholesaler would just internalize that flow, right? Wholesaler gets a retail customer order, they internalize it, they execute it against its own inventory. Customer probably gets a pretty good execution, right? And they call it a day. Under the proposal, right, once the retail broker dealer routes the customer's retail order to the wholesaler, what the wholesaler has to do then before executing that internally, the wholesaler has to submit that order to the auction, right? And so before submitting that order to the auction, the wholesaler has to tag it at a specific price, right? So the wholesaler might know what price it's going to execute it at internally. Doesn't matter, right? It has to submit that order to the auction at a specified price. It could be at the price that it's going to execute internally, or it could be at a sort of a less aggressive price, right? Doesn't matter. It has to submit it to the auction, right? So once it submits it to the auction, right, it goes into the auction, and it waits for responses, right? And during that time, it might get a bunch of responses, it might not, right? So responses can either come from a bunch of different brokers, it can come from institutions, it can come from a bunch of different trading centers. It has to be exposed in the auction for, I think, between 100 and 300 milliseconds, right? If there isn't a fill in the auction, then at that point, it can come back to the wholesaler and the wholesaler can internalize it and fill it. That's effectively how the SEC described how this process would work. So we'll get into the weeds in terms of the mechanics, but sort of in a nutshell, that's sort of how they described it. Now, there are some questions as to sort of the pricing mechanisms and whether the wholesaler can sort of price it going into the auction in a way to guarantee that it's going to fail. I was looking for language in the release to see if they addressed that. I couldn't find it right off the bat, but I'll look again. But that was my immediate thought, right? That there's a very good chance you can just price it in a way where it's going to guarantee to fail and come back to the wholesaler for filling. But we'll get there in a second. So let's get to the mechanics rule 615, right? So restricted competition center, right, is any trading center that is not an open competition trading center and is not a national securities exchange. So a trading center is pretty much just defined as an OTC market maker or an exchange market maker, right? So when you strip away sort of what a trading center is, it's pretty much just a wholesale broker dealer, right? A segmented order. When you strip it away, it's pretty much just an order for a retail customer, right? So it's an order for an NMS stock that is for an account of a natural person, right? So an individual, or an account held in legal form on behalf of a natural person or a group of related family members. And two, in which the average daily number of trades executed in NMS stock is less than 40 in each of the 6 preceding calendar months. So who does that exclude, right? It's effectively going to exclude probably day traders, right? Those are probably the only people who really are executing trades on a daily basis in that amount. So what's an order competition trading center, right? It's either going to be an exchange or an ATS that meets certain requirements, right? It has to operate as an automated trading center and has to have public displays of automated quotes that are disseminated pursuant to Rule 603. So Rule 603 is the vendor display rule, right? That rule is just the rule that talks about displaying quote and last sale information, right? So the feeds you're getting, displaying last sale information and sort of active quotes, that's Rule 603, right? That's the vendor display rule. And so you have to have certain volume requirements and sort of this limitation, this last bullet here, there has to be a limitation on sort of the trading center's system capabilities, right? In terms of it just can't be operating as a qualified auction, right? And a qualified auction just means that you have to operate as an open competition trading center, which means, right, you either have to be an exchange or an ATS that meets these requirements in order to be a qualified auction, right? So what's a qualified auction? Well, these are your requirements for being a qualified auction, right? So auction message. So you have to announce and disseminate the auction invitations pursuant to Rule 603. right? So remember the last sale reporting and your quote information you get through the vendor display rule. That's how the auction information is supposed to be disseminated, right, to the tape, right? So you're supposed to disseminate through the tape that an auction is about to happen, right? And so you're supposed to be able to get, you're supposed to be able to get a mechanism or a pipe back to be able to respond to that auction, right? And so in that message that you're sending out through this last sale reporting mechanism to the vendor display rule, you're supposed to be able to sort of identify the open competition trading center, right? So let's say it's NASDAQ or NYSE or it's an ATS, right? You're supposed to be able to ID, okay, this is the competition center where the auction's happening. This is the symbol. This is the side, right? Either buy or sell, right? The limit price, the identity of the originating broker for the order. In some circumstances, the counterparty ID can be anonymous, right? So I think that's a helpful sort of requirement that we'll get to information leakage a little bit later, right? But all this information is effectively going to be publicly available, right? You might not get counterparty information out there, right? Because it might be anonymous. There's going to be some provisions of the rule that let you not disclose this information. Oh, pardon me. But this info is going to be exposed to the market, right? Because it's going to be disseminated under this rule, right? So the auction message is going to be disseminated out under 603. And anyone can respond, right? As long as they have the capability to do so. So institutional investors and broker dealers and anyone who has the technological capacity to be able to respond back within the required timeline. Auction responses. So auction, you have to be able to accept an auction response for a period of at least 100 milliseconds after an auction message is provided for and disseminated, right, in market data. And the auction shall end no more than 300 milliseconds after an auction message is provided for, right? So once you push out the auction message, right, these are your timeframes. That's effectively how long the auction remains open. But there are some practical considerations here, right, that you have to take into consideration, right? Years ago, right, when we were talking about sort of high frequency traders, right, one of the biggest issues we were talking about was latency, right? How fast are you getting this information, right? I'm not sure we've addressed these issues yet. And given how quickly responses have to be made. Oh no. Bear with me. Pardon me 1 second.
While you're
Fixing this.
while you're pulling that back up, can I so practically,
Yeah.
so basically you're exposing how you expose the orders through the auction message.
Yep.
And you have like milliseconds to respond. But let's say, I'll make this super simple. Let's just say when you expose it, the market price is, or the price that you can get there is $4 a share.
Yep.
But you could route it internally and buy it for $3.99. How does practically this work, given that we're talking about milliseconds here in terms of exposing it and then responding to it and then seeing an order that's better somewhere else?
Wow, that's the rub, right? So you have to, the one thing that I don't think they've reconciled, and what Commissioner Peirce, I think, was hinting at, is this rule hasn't been reconciled with, for example, your best execution obligation, right? So, at the end of the day, if you're gonna internalize this order at a better price, right? If you're a wholesaler and you're gonna internalize this order at a better price, you still have to expose, no matter what, you still have to expose the order to an auction, right? So the issue here, and the issue that I don't think they've solved for, right, is price disimprovement, which is the issue that we're trying to deal with here, right? Because for the brief milliseconds that you're trying to expose this order to an auction, you may not get any responses, right? For that period of time that you have an order and you have all this information being exposed out, even in milliseconds, right? For that amount of time that you're having your order information exposed out to the market, right? One, you can have price disimprovement, right? You can have the market move against you, but two, right? I am, betting 100% that you're going to have predatory traders that are going to start, programming their algorithms to sort of either reverse engineer, right, where potential order flow is coming from to try and take advantage of that. Right now, arguably, this is retail flow, right? So, in some respects, they might be taking the view that this information, the order sizes here aren't big enough to be able to engage in sort of predatory trading activities. But some institutional investors might want to have their flow exposed to retail flow. So I'm not sure that this exposing orders like this, I am particularly concerned about sort of information leakage, but also price disimprovement. I'm not sure that this really sort of yes, arguably it exposes an order to competition, in theory. Not sure it really gets customers any meaningful price improvement.
Got it. Thank you.
Your other requirements for the auction, pricing increments. Again, sub-penny, this goes back to sort of the tick size proposal, right? So again, correlation to the other proposals. Here, fee requirements, we discussed these a little bit earlier. So no fees or rebates. However, if there are any fees or rebates, they'd be capped at 0.0005 cents per share. Again, that correlates to the sort of the change in the access fee caps that we discussed a little bit earlier. And then there would be sort of execution priorities highlighted here, right? So this is presumably this is a way that wholesalers and others are not supposed to be able to game the auction process. So highest price response to buy, lowest price response to sell shall have the highest priority, and then sort of it's just a waterfall from there. Not sure that really sort of solves the issue in terms of priority or really getting clients price improvement or sort of the best price, especially if you're getting, especially if this information is being disseminated on the tape. Notwithstanding that the identity of the broker originating the order, notwithstanding that there may be mechanisms to sort of hide this information. But again, I think one of the things that sort of jumped out at me about this proposed rule is that what the SEC said is that they're modeling this auction requirement off of what is done in the options exchanges. And sort of the other thing that really stuck out to me is that in terms of the technological build for this, and this would require a significant technological build, I think, the SEC, I think, was pretty blatant in its acknowledgement that really the only folks out there that at this moment really have the capability to build something like this out are the exchanges, right? So, it doesn't really advance, so when the SEC says that they're trying to sort of increase competition, again, the cynic's view here is that increase competition or increase the exchange's competitiveness against wholesalers, given that, exchanges are really the only ones who are in a position to sort of build this out. Again, as a former regulator, I'm a little bit cynical You know, they used to say in the building, it usually takes about 3 years for someone to become cynical after having worked in the building or, you know, the commission. I can attest that that's actually kind of accurate, but don't quote me on that. So next, you know, there are a couple of exceptions to the rule, right? So obviously you don't need to sort of send an order to an auction if there isn't one being operated. I suspect that this exception is going to come into play a lot, in that there may not be a lot of auctions being operated for this. If the orders for more than 200, right? No need to route there. So a couple of, you know, other exceptions here as well. I think the key here for these exceptions is that you don't have to route if you come within an exception, but it's optional. If you want to route to an auction, you can, even if an exception applies. And then for an originating broker, right, that's the broker that's originating an order to either the wholesaler or to whomever sends the trade to the auction. You know, they have to have policies and procedures to ID these segmented or these retail orders, identifying the orders as such. And if they don't want to be disclosed, they have to have policies and procedures in place regarding, you know, not having their identity exposed in the auction. So again, you know, in a nutshell, that's how this auction process is supposed to work. I'm not sure it's going to have the intended effect, and you know, I'm not entirely sure that we're going to have many auctions being operated, or at least not very many that are being operated by entities that aren't, you know, the established exchanges. Assuming that this rule actually gets adopted as proposed. I've spent a lot of time on that one, but you know, I'll quickly run through the best execution rule. So again, it consists of 3 parts, right? One is the standard. It's proposed rule 1100. 1101 is really consists of 4 subparts. It's the policies and procedures. One deals with conflicted transactions. Another part of that rule requires BDs to sort of review execution quality. And a last one provides an exemption for introducing brokers. And then a third part of the rule requires annual reviews of policies and procedures and their effectiveness and approval by a board of directors. So the standards, you know, pretty straightforward, right? Consistent with the FINRA requirement. Ascertain the best market for security and execute a transaction so that the resultant price is as favorable under the prevailing market conditions, right? Different standard than the one for advisors, more focused on price. When you read the release, the SEC is a little bit more focused on midpoint execution for purposes of this standard. Couple of exceptions, right? So there's an exception if you're executing against another broker's quote. There's an exception for institutional customers, right? So if an institutional customer exercising independent judgment executes against a broker's quote, there's an exception for that. The problem here is that they don't define an institutional customer. They ask a comment about that, about whether they should define it. They start off with a QUIB standard, asking whether that should be the standard for an institutional customer. They also ask whether they should use the FINRA 4512 standard, institutional account. But they don't go into detail as to you know, what that standard should be. And then finally, they have a carve out for directed order exception, right? So if the customer says, hey, I want you to route my order to broker dealer XYZ, right? You don't have a best execution standard. The problem with the directed order exception, and we'll talk about this a little bit later, is that even if a customer says, hey, route my order to a wholesaler, I want the wholesaler to internalize that order, you can't square that with the order competition rule, right? Because the order competition rule still says that, hey, wholesaler, you still have to expose that order to the auction, right? So as between those 2 releases, there's still a disconnect, right? So even if the customer wants wholesaler to internalize, wholesaler still has a separate rule that says, hey, ISO got to expose this order to this auction process. So a bit of a disconnect there. So quickly, just policies and procedures. So policies and procedures require the BD to sort of comply with the best execution standard. So they have to show that the BD obtained and assessed reasonably accessible information regarding price, volume, and execution, and they identified markets reasonably that are reasonably likely to provide favorable prices, some material potential liquidity sources, and that they incorporated all this information, analyzed it, and sort of used that when sort of analyzing their order handling practices, right? So reasonable information includes, like trade report data, real-time feeds, that sort of thing, material potential liquidity sources. This is where those 605 reports we talked about a little bit earlier, right? That's where they're sort of all that new data, that's where that's going to come into this, right? So all those new data sources, that's going to have to be fed and likely going to be sort of considered and used when a broker dealer is going to have to sort of analyze this information. This is going to be easier in the equity markets because there's going to be a ton of new data that brokers have to consider. In all the other markets, probably a little bit more difficult, right? When you go into the releases, the SEC says that, hey, like for example, in the fixed income markets, you got to consider sort of like RFQ platforms, right? And consider sort of the information you're getting there, right? But not everyone's gonna have access to all RFQ platforms, right? So that's gonna be an obvious limitation. So I think that's actually a duplicate slide. Sorry about that. Conflicted transactions, right? So if the SEC went out of its way to say, hey, we're going to identify certain types of transactions as conflicted, and if these transactions, if you're going to enter into some of these transactions, you kind of have a heightened standard, right? And so these are sort of principal transactions, including riskless principal transactions, transactions you route to an affiliate, and any transactions where you get payment for order flow. Any one of those three transactions, if a broker sort of executes those, you have a heightened best execution requirement. So what that means is that you have to get even more information than you would have required, originally. You have to identify even more markets when considering whether you're going to execute one of these transactions. And then you have to document everything else you did to sort of figure out whether it's still the best price when you're executing these markets. So again, when you're executing one of these transactions, again, one of the issues here, sort of one of the running themes here is that all this takes time, right? And so there's always a risk that you're going to run into sort of price disimprovement, right? Where you're doing all this stuff, right? The market can suddenly move against you, right? So is it going to be worth it at some point? You're going to have a cost benefit analysis, right? Okay, I can route to this market and get payment for order flow, but the market's going to move against me. Is the SEC suddenly going to sort of question my best execution, my best execution obligations here? And the one thing I did forget to mention, right, is like unlike the FINRA rules, the SEC adopted, or rather is proposing, the best execution rule under Section 15C of the Exchange Act. Section 15C is an anti-fraud provision applicable to broker dealers, right? So I think they went sort of out of their way to mention that they were proposing it under that rule. So that wasn't lost on me. They mentioned it. They front loaded it and mentioned it up in the front, but really sort of didn't give it more lip service other than that. Regular reviews of execution quality. So BDs, I think this is consistent with the FINRA standard, right? You have to regularly review your execution quality. Nothing new here other than it's an SEC rule now. A carve out for introducing brokers. So introducing brokers wouldn't have to have this whole litany of execution requirements and policies and procedures, right? Pretty straightforward. Can't carry customer accounts. They have to enter into an arrangement with an unaffiliated broker dealer that's going to handle the transactions only on an agency basis. They can only trade principal for fixed. They can only trade on a principal basis for fixed income or fractional shares. But this one's probably the biggest one. They can't accept any remuneration from the clearing broker, right? So if you have these three components and you're an introducing broker, you don't have to have this best execution sort of framework in mind, but you still have to have policies and procedures to sort of review the execution quality of your clearing broker. And then you have to have annual reports. If you're a broker dealer subject to the best execution rule, you have to have an annual review of your best execution policies and sort of have your board of directors sort of review them and consider them and sign off on them. So, implications, obviously the big one is the best execution standard for advisors is obviously different than it is for broker dealers. That's not new. It's always been different. The only issue now is, broker dealers have an SEC rule now or they may have an SEC rule now that they're going to be subject to, right? And there's going to be, assuming this package of rules gets adopted as is, likely not, but pretty close. The SEC broker dealers are going to have a lot more data that they're going to have to analyze, right? And to some extent, this may carry over to a money manager or an advisor's obligation to analyze this data, or at least consider it, right? Especially since the Rule 605 reports are going to be provided in a human readable format now, right? Much like the 606 reports are going to be provided. For smaller advisors, that may be more of an issue, right? For the bigger advisors that are part of larger enterprises, where a lot of this data is going to be collected and analyzed anyways, it may be built in and maybe a sunk cost that part of the enterprise is absorbing anyways. Maybe more of an issue for these smaller advisors. As I mentioned earlier, the SEC best execution rule contemplates an exception for sort of institutional accounts or institutional investors, but it's not defined, right? I guess the question for investment advisors and money managers is, do we want to carve out, or should orders coming in from managed accounts or advisors be subject to the SEC best execution requirements as is? And given that broker dealers have to start producing execution reviews and start considering these metrics and analyzing these things at least on a yearly basis, in some instances on a quarterly basis, should money managers start considering asking for at least a summary of what a broker dealer's findings are or reviews are? The SEC is, talked about excluding family offices from the extra hurdles that broker dealers have to consider when affecting transactions and conflict, or from best execution requirements with respect to conflicted transactions. That's something for family offices to consider, perhaps comment on. Not sure if it's worth it. Obviously it's something for it eases the burden for broker dealers. Not sure if it adds anything or is of any benefit for family offices, that is. Price disimprovement issues and information leakages, I think that's much more of an issue, I think, especially for the buy side. Again, there's a disconnect, and I think Commissioner Pierce sort of recognized this. There's a disconnect among the different sort of proposals, right? And I think that you see this as between the best execution rule proposal and the order competition rule proposal. The order competition rule proposal sort of dismisses a lot of the concerns about information leakage, or rather price disimprovement. Whereas the best execution rule was a little bit more concerned about that, right? And as I mentioned a little bit earlier, there's a lot of data that's going to be exposed through the vendor display rule when an auction goes out, right? So there's a lot of opportunity for price disimprovement, and there's a potential for predatory trading behavior just based on the information that's going out. Directed brokerage, I think I mentioned this a little bit earlier. Even though under the best X rule, you can direct that your orders go to a specific venue, wholesalers still have to expose order flow to the order competition rule. So there's a bit of a disconnect there. So institutional customer exception and auction opt-out. Again, not sure whether you can opt out of the auctions if you're an advisor or a money manager. And then the question is whether it makes sense not to opt out, whether your client flow should be exposed to auctions, especially if auctions do end up providing price improvement to your end clients. Sweep arrangements. This is one thing I did flag in some of our pieces, especially for introducing brokers. If introducing brokers want to take advantage of this exception to not have fast execution policies and procedures, one thing they can't do is receive revenue from clearing brokers for orders. A lot of the revenues introducing brokers get now is from sweep programs. Because sweep programs are either going to sweep into money market funds or bank deposit programs. And you get revenue from both. And money market funds are securities, and therefore there are orders. This may signal even more of a move to bank deposit programs if this ends up happening. And then soft dollars and hard dollars, right? That hard dollar release is going to expire in July. Not sure if it's going to be extended. The best execution release is silent on commission charges. So assuming that payment for order flow gets, there's a chilling effect associated with that receipt, it's unclear whether we're going to see brokers charging commissions again. So I know we're a minute over the hour. I know it was a lot of content. Hopefully you all found this a little bit somewhat useful. Happy to answer any questions to those who want to stay around, or even by email or through other means.
Thank you, Ignacio. That was really helpful. Excellent explanation of all the proposals and potential implications. Before we conclude, does anybody want to ask any questions?
Hi, Monique, this is Sarah Ronenberg from Horizon Investments.
Hi, Sarah.
Hey, Ignacio, thank you so much. This has been so helpful. Just to follow up on best execution requirements for advisors, it is so qualitative and subjective. When you're a mid-sized advisor and you don't have the retail customers, but you have sizable SMAs, or even you're trading for a smaller mutual fund, being a qualified institutional investor, because sometimes you need your broker to work the order, and putting it in auction is going to be very difficult. I mean, you actually have to look at your privacy concerns when you're evaluating your brokers for your best execution. How is that going to work? And then how may we be dinged if the SEC has all this data from the brokers, and then they come and look at who we're using and whether or not we somehow got caught in the crosshairs of their best execution rules versus our subjective best execution expectations?
I mean, that's a good question. And I think, it's telling that the SEC, if you look at the request for comments in the best X rule, it's clear that the SEC didn't sort of consult with investment management on this, because the reference to an advisor's best execution requirements was really just in passing. But I think they were trying. I think what the staff, at least in the order competition rule, I think what the staff was trying to sort of address these issues somewhat by permitting originating brokers to be somewhat anonymous. And I think they were trying to address it that way, but I don't think it's enough. And I think the reason for that is a lot of these traders out there are pretty sophisticated and can sort of reverse engineer where orders are coming in from and sort of figure out where the strategy is coming from. And so the reason I mentioned this is because this was one of the concerns in the sort of securities loan proposal that a lot of the industry sort of highlighted. was that even though a lot of this information may be anonymized, there is just enough information that is going to be publicly available that you can sort of reverse engineer who's on what side of this. So, I think it's a real concern, and I think it merits sort of highlighting to the commission, because, I mean, quite frankly, I think it's just something they didn't really consider.
Thank you. Anyone else have a question for Ignacio? Okay, great. Thank you, Ignacio. On behalf of the IAA and our members, we really appreciate your time and sharing your expertise. I did put this in the chat, but we will post a recording of the webinar and also the slides to our webinar page. But feel free to email me in advance if you'd like them before that gets posted. If any members on the call are interested in discussing the proposals further or joining a work stream for our comment letter, please let us know. We look forward to working with you to develop comments and discuss implications for advisors of these rule proposals. So again, thank you all for joining us today. Thank you, Ignacio, and have a great weekend.